Hey everyone, Assalamu alaikum. Welcome to T Accounts. So in this video we will be starting with the past paper solution, and the paper that we'll be doing is October November 20 paper 23, right? So this paper is of 100 marks, and 100 marks means that there are 5 questions in this exam and each question is of 20 marks, right? So in this video we will be solving question number 1 only. Let's begin. The question says, Saria owns a business selling ladies' clothing. Very good. She maintains a system of double entry bookkeeping. Very nice. Now, the following occurred during September 2020. So, the year end is September 2020. Now, what occurred? Number 1, she purchased a motor vehicle on credit from Sharpe Motors amounting to $6350, and another transaction, Ruhi, a credit customer, was declared bankrupt, owing Saria $1200. The debt is to be written off, right? So, one transaction is related to the purchase of a non-current asset and the second one is related to bad debts. Now, what is the requirement? The requirement is prepare journal entries to record the above transactions, and narratives are not required, right? So, please make sure that you read the question very carefully. Sometimes narratives are required as well. So, if you just assume that narratives will not be required for any question, then you might end up losing 1 mark for each narrative that you might be asked to write. Okay. So, in this question we do not have to write the narratives and we just have to record the double entries for these 2 transactions. This part is of total 4 marks. Now, in the first transaction, what is happening? Purchased a motor vehicle on credit from Sharpe Motors. Alright. So, which account should be debited? Should I debit purchases account or should I debit motor vehicles account? What do you think? Since she is purchasing an asset, so shouldn't purchases account be debited? No. Purchases account will not be involved. Why? Because we know that if I want to make an entry in purchases account, this means that the transaction would be recorded firstly in the purchases day book. So, we know that what goes in the purchases day book? Only the credit purchases of inventory, right? So, only inventory purchased on credit, they are recorded in the purchases day book, and then that total is posted to the purchases account as well. But if you are buying any non-current asset, that too on credit, so that will be recorded in the general journal, right? So, how will this transaction be recorded? So, motor vehicle will be debited. Whenever you are purchasing any non-current asset, you have to open its account with its own name. In this case, motor vehicle will be debited with 6350 and purchases account won't be involved at all, right? And from whom is she purchasing? From Sharpe Motors, so that account will be credited, establishing this company as other payable for Saria. She has to pay this company back after a time, right? So, this is how this will be recorded. Now, number 2, Ruhi, a credit customer, was declared bankrupt, owing Saria $1200. The debt is to be written off. So, we know that this is a bad debts question, bad debts transaction, sorry. So, whenever there is a bad debt in the exam, in the transaction, bad debts being an expense are always debited, right? So, bad debts is an expense, it is always debited, and against this debit entry we credit the customer, indicating that we won't be receiving this much amount from this person now or in future. So, we are now closing off the account with the balance that she owed, that he or she owed. So, bad debts, or you can also write irrecoverable debts. Irrecoverable debts will be debited with 1200 and Ruhi, the customer, will be credited with 1200 as well, right? We are done with the second transaction as well. Now, let us move to the next part of this question, which is of depreciation. Now, this is a very good question if you want to practice depreciation. Why? Because it involves 3 types of accounts. In fact, all types of accounts that can come in depreciation topic. First one, you have to prepare the fixtures and fittings, that is the non-current asset account. then also its provision for depreciation account, and there is a disposal in question as well, so we have to prepare that account as well. And the total marks for preparing these 3 accounts is 11 marks, right? So this is a big number. And lastly, there is a part for partnership, right? So we'll be discussing that as well. Now let's start with reading the details given to us for depreciation. Saria is preparing her financial statements for the year ended 30th September 2020. Dates are very important in accounting. Whatever topic you are doing, dates are really important, so make sure that you mark the dates very carefully. And one more thing that you also should do is whenever you come across the year end, write down the year beginning as well, that what will be the beginning date of the year as well, right? So if 30th September 2020 is the year end, what would be the year start? What comes after September? October, right? So 1st October, and the year would not be 2020 but 2019 in this case, right? Even if the year is given to you in question, make sure that you make this habit of writing the year start as well, because sometimes it might not be given to you, right? Okay, so she provides the following information for fixtures and fittings. Now first of all, we have the balances brought down. 2019 October 1, fixtures and fittings at cost and provision for depreciation of fixtures and fittings, right? So what are these? These are the balances brought forward, the opening balances, all right. Then what is happening during the year? In 2020 January 31, so same year, same accounting year but different calendar year, but in the same accounting year, what is happening? She sold fixtures and received a check amounting to 1150. All right, so make sure that you are annotating as well. If she is selling fixtures and she is receiving a check for 1150, so this 1150 would be what? The disposal proceeds. And we know that where do we record the disposal proceeds, or what is the double entry to record disposal proceeds? If she is receiving a check, so bank will be debited with 1150, and which account will be credited? The fixtures and fittings account. No, never. We never record the disposal proceeds in the non-current asset account, but rather in the disposal account. So disposal account will be credited with 1150 as well. Also what is given to us is the fixtures had been purchased on 1st February 2018 for 1500. So 1st February 2018, the date is given to us, and what is this? The 1500. This is the cost. Why the cost would be given to us? So that we eliminate the cost from fixtures and fittings account, right? We know that what is the double entry? To eliminate the cost of an asset which is being disposed of during the year. How do we do that? We debit disposal account with the cost, of course, in this case that is 1500, and we credit the fixtures and fittings or non-current asset account with the cost as well, to eliminate the cost from the non-current asset account. And why the purchase date is given? So that we calculate the accumulated depreciation on this asset from the date of purchase till the date of sale, right? But we have to first read the policy in the question as well, that what is the policy, full year or monthly basis. Lastly, we are also told that on 31st March she is purchasing new fixtures, again paying by check amounting to $3,500, right? So in this question we have the brought downs for both depreciation and the non-current asset account. Then there is a disposal in question. We are given with the required information for that as well. And lastly, there is a new purchase of non-current asset as well. Again, all happening in the same year. Now let's read the policy, very important. Saria's policy is to provide depreciation on fixtures and fittings at 10% per annum using the reducing balance method. All right, so in reducing balance method, what do? We charge depreciation in the current year on the net book value of non-current asset, and by net book value I mean cost less accumulated depreciations of all the previous years so that you have the net book value, and then you would apply 10% on that amount. And also a full year's depreciation is charged in the year of purchase, but none in the year of disposal. So even though she is purchasing new asset on 31st March, that is how many months before the year end, April, May, June, July, August, September, just 6 months before the year end, we will be charging full year depreciation on 3500. And she is, even though she is disposing of this asset, the old fixtures, on 31st January, we will not be charging depreciation on this one in the current year ending 30th September 2020. And whenever we are charging depreciation, we will be following the reducing balance method, right? So it's very important that while reading the question, you read it slowly, you read it very carefully, and you are continuously annotating the question as well, because by the time you will be starting with the solutions, there are high chances that you might have ended up forgetting many of the details given in the question. So now let's begin with the requirements. We are asked to prepare the following accounts for the year ended 30th September 2020. Close the accounts by balancing or by making an appropriate year end transfer. So first we have to write down the years. So the year, the timeline again, let's write down the timeline again. It was, the year start was 1st October 2019 till 30th September 2020. So the broad downs that are given to us are for 1st October 2019. So 2019 would be my start. Then I have to write the balance brought down on my fixtures and fittings account. So the balance brought down given to me is $28,600, right? Let's write that down, 28,600. Now what else should I record in my non-current asset account? Number one, there was a disposal in question, so I have to eliminate its cost. And number two, there was a new purchase of non-current asset in the same year as well, right? Both of these are happening in 2020, right? So now I can change my year, 2020. What is happening first? The disposal is happening first, right? So how do we eliminate the cost of the asset being disposed of in the current year? We credit the non-current asset account. By crediting non-current asset account, I will be decreasing its balance with the cost. So the cost was 1500, and we have already written down the double entry: disposal debit and fixtures and fittings will be credited with 1500. This is happening on January 31. So disposal amount is, the cost is 1500, right? Next thing that is also happening is we are purchasing an asset on 31st March. So how do we record the purchase of any non-current asset? This is being financed through bank. So bank account will be credited with 3500, and my fixtures and fittings to show an increase in its balance will be debited by 3500 as well. So in my fixtures and fittings account on 31st March, I will be writing bank amount is 3500, right? Now, are there any further transactions for which can be recorded in this account? No. So now I just have to balance this account, and the balancing is done always on the last date, which is 30th September 2020. So on September 30th, my balance carried down would be, this would consist of the old asset subtracting the asset which is being disposed of during the year and adding the one which I am purchasing in the current year. So 28,600 plus 3,500 less 1,500 would be $30,600. This is my balance carried down. So my total is 32,100, both the sides. And lastly, we have to bring down the balance for my next month. So after September, again October 1st, same year 2020, but different accounting year, balance brought down $30,600, right? Please make sure that you don't forget this part as it carries 1 mark. Now let's move to the next account, in which we have to prepare the provision for depreciation of fixtures and fittings account. So again we will be starting with the balances brought forward. The year is same, that is 2019, and we know that since provision for depreciation is a contra asset account, so its balance brought down will be shown on the credit side as it decreases the value of non-current assets, right, the provision for depreciation. We have the balance brought down, and that is 6185 on 1st of October 2019. So 6185 on the credit side. Now what else will come in this account? There are a total of 4 things which you should keep in mind, that these are the maximum things that can come in a provision for depreciation account, right. So let us list that down first. Number 1 is the balance brought down. If of course this is the first year the business is charging depreciation on any non-current asset, then the brought down balance won't be there, but in mostly brought down balance is given to you. Then we have to calculate the current year income statement charge, the current year depreciation charge on the non-current assets present in the business at year end. Then if there is a disposal in question, so we have to eliminate its accumulated depreciation from provision for depreciation account, and lastly will be the balance carried down. So we have written down the balance brought down. Now we have to find out these 3 things, right. So firstly let us calculate depreciation on the asset which Saria is disposing of during the year. The accumulated depreciation, of course, the policy was to charge depreciation on 10% using the reducing balance method, and a full year's depreciation is charged in the year of purchase but none in the year of disposal. So even though I kept this asset, these fixtures which I am disposing of in January 31, I kept them for how many months in the current year? October, November, December, January. Even though I kept them in the business for 4 months in the current year, I still won't be charging any depreciation on these fixtures for the year ended 30th September 2020. No. So how many months of depreciation should I now be charging on this asset? We have to find that out. For that we will be needing some space for calculations. So firstly we will be charging depreciation on the asset, which the accumulated depreciation, of course, I will be finding out the accumulated depreciation on the asset which I am disposing of during the year. Now this was purchased on, what was the purchase date? 1st February 2018 for 1500. Okay, 1st February 2018, the cost was 1500. Okay, now we know that what is the timeline, what is the year that Saria's business follows. The year is from 1st October till 30th September, right. So from 1st October till 30th September. Now in which year do you think this asset would have been purchased? What would be the year start and what would be the year end? Since this is falling in 1st February 2018, so this means that your year end would also be 30th September 2018 and your year start would be 1st of October 2017, right, because then after December 2017, 2018 would have started and this would have been purchased in this year, in this accounting year. So this was the year 1. Then the next year would be from 1st October 2018 till 30th September 2019, right, and currently I am standing in the 3rd year, which is 1st October 2019 till 30th September 2020. So why am I writing down these years? Is because I have to find out the accumulated depreciation on the asset which is being disposed of in the current year. Of course, I won't be charging depreciation in the current year, no, but I have to know that how many years it has been depreciated. So these are 2 years. Okay, so the accumulated depreciation that I now have to eliminate from provision for depreciation account would be of 2 years on this asset. So year 1 the cost was 1500 and the policy is to charge depreciation of 10%. So that would be 150 in year 1, which will give me a net book value of 1350. Then for year 2 again depreciation will be charged on now the net book value. So 1350 into 10% would be 135. And then the net book value would be 1215. So what is the accumulated depreciation? 150 plus 135. Accumulated depreciation is equals to 150 plus 135, that would be $285 from the date of purchase till the date of disposal, or for the 2 years that it remained in the business. Now if I have to eliminate it from my provision for depreciation account, what is the double entry for that? Your provision for depreciation of fixtures and fittings account will be debited with 285. Why debited? Because being a contra asset account, it decreases on the debit side. I am eliminating the depreciation, so I am decreasing its balance. And my disposal account will be credited with the same, right? So let's write that down in provision for depreciation account. Now the year has been changed, right, because I am disposing of on, what was the date? January 31, right? So on January 31 disposal, the accumulated depreciation 2 years, 285. Okay, so we are done with the accumulated depreciation as well. Now let's find out the current year charge on the fixtures and fittings which are still there in Sarya's business, right? So what is the current situation in her business? So how many types of assets are still there in her business? The fixtures and fittings, of course. We know that there was a balance brought forward in fixtures and fittings account amounting to 28,600. We are purchasing an asset as well and we are disposing of an asset as well, and the policy is to charge depreciation on using the reducing balance method. So let's first charge depreciation on the new asset which is purchased during the year. It had a cost of 3,500. Now since this is the first year, I don't have any accumulated depreciation. So in the first year, even though we are following the reducing balance method, depreciation is charged on cost. So that would be 350 for current year. Then next we have some old assets as well, right, because we were given the balance brought down for those. And what was that? 28,600. So 20, so I have to charge depreciation on this as well, right? But these are the costs of all the assets at the beginning of 2019 or on October 1st, 2019, the beginning of the accounting year. Now this includes the asset which I have disposed of in the current year as well. So I can't just take the cost and subtract the accumulated depreciation brought down from it so that I arrive at net book value and then apply 10% to calculate current year depreciation charge. I can't do that because I first have to eliminate the cost of the asset which I have disposed of during the year from the balance brought forward. So 28,600 is the total cost. At the beginning of the accounting year, I will be subtracting the cost of my disposed of asset, which will be 1500. So 28,600 less 1500 would be 27,100. Now this is the total cost of all the old assets which are still present in Sarya's business. Then we have to subtract the accumulated depreciation. Of course, we are again given with the balance brought forward, which was 6185, but again this also includes the depreciation, the total depreciation on the asset which is being disposed of during the year. So, I have to now subtract its accumulated depreciation as well, so that I have just the depreciation of assets present in the business in the current year. So, 285 will be subtracted from balance brought down, which will give me a total accumulated depreciation on the assets present by the year end of 5900, right. Now, my net book value of these assets is $21,200, right. This step is very important, otherwise you will end up taking wrong figures and wrong depreciation. So, your balance CD will be changed, your current year depreciation charge will be changed, and you won't get the marks, right. So, this is the net book value. Now, I have to charge current year depreciation, which is 10%. So, 21,200 into 10% would be 2120. This is the current year depreciation charge on my old assets which are still there. So, if I ask you that what will go in my income statement for the current year as depreciation charge, so that would be 2120, which we have just calculated on the old assets purchased few years back, plus the asset which we bought in the current year, so its depreciation as well. So, 2120 plus 350 is my current year depreciation charge, which is 2470. And what is double entry to record current year depreciation charge? Now, being an expense, we know that all the expenses are debited in the income statement. So, income statement will be debited with the current year charge of 2470, and my provision for depreciation will be credited. Why credited? Because again, being a contra asset account, it increases on the credit side. So, the current year depreciation will increase its balance. So, this will be recorded on the credit side of provision for depreciation account on what date? On last date, year end date, September 30th. Income statement 2470. Lastly, so we are done with this as well. Now, we just have to total the account and bring down the balance, that is the balance carried down, that will also be found on the last date on the debit side, of course. So, balance carried down would be how much? 6185 plus 2470 less 285. So, that would be 8370, which will give me a total of 8655 for both the sides. Now, what does this CD represent? It represents the total depreciation on all the assets which are present at the year end in Saria's business. It does not include the asset which was disposed of during the year, or its accumulated depreciation has been subtracted. So, this is the current depreciation so far from the date of purchase till today's date on Saria's non-current assets. Lastly, we have to bring down the balance on 1st October 2020, which will be the balance carried down at 30th September 2019. So, 8370. Now, let us move to the last and the most sweet account, the disposal account. In this, we just have to show everything related to the asset which has been disposed of during the year. So, the disposal date was 31st of January, right, 2020. So, you do not have to write down 2019 over here. So, it is being disposed of in 2020. So, just write that down. 2020, the first entry will be to write down the cost. So, disposal account debit, and just as we have credited fixtures and fittings account. So, on January 31 on the debit side, I will be writing fixtures and fittings, of course, the cost, right, and that was 1500. Then what will come on the credit side? Firstly, the accumulated depreciation. What was the double entry? Provision for depreciation debit and disposal account credit. So, I will be writing over here provision for depreciation 285. Then we also have to write down the disposal proceeds, right. So, how much are we receiving? We are receiving 1150. So, bank debit and disposal account credit with 1150. Now, we have to see that whether there is a profit, there is a gain or loss on disposal. So, my debit side totals 1500. What is the total on the credit side? 285 plus 1150 would be 1435. So, there is a loss, right. Loss of how much? Of 65. So, that will be transferred to the income statement on the last date of your financial year, that is September 30th. Income statement, the difference, which is the loss, 65. What is the double entry to record a loss on disposal? We know that all the losses are debited in the income statement. So, income statement is debited. I will write that down as well. If there is a loss on disposal, income statement is debited and your disposal account is credited, right. Now, why is there a loss? If we just see that what was the net book value by the end, or by the end of the second year when we were depreciating it, the net book value was this 1215, right. It had a value of 1215 by the time it was depreciated and the owner decided to sell it in the next year. And how much are we receiving? We are receiving 1150 against it. So, against a net book value of 1215, we are receiving 1150. So, we are receiving $65 less. So, that is what the loss is, and that is shown on the credit side of my disposal account. So, what is the rule? If the net book value is more than the disposal proceeds, there is a loss on disposal, right. Just like in this case, net book value is 1215, disposal proceeds are 1150. So, there is a loss. And if the net book value is less than the disposal proceeds, so there is a gain on disposal, right. So, this was a really interesting question, right. It could have been made a bit more complicated if you were asked to charge depreciation using the monthly basis policy. But this is a very good question in which you were required to prepare all the three accounts: non-current asset account, the depreciation account, and of course the disposal account, right. So, let us move to our last part of this question, which is part C. Okay, so part C says Saria is considering forming a partnership with her friend Amy, who runs a similar business, right. So, same clothing business. Now, you are asked to advise Saria whether or not she should form a partnership with Amy, and we have to justify our answer with two advantages, two disadvantages of forming a partnership with Amy, right. So, this question is of 5 marks, which means that 2 advantages each of 1 mark and 2 disadvantages of forming a partnership with Amy, and lastly 1 mark for recommendation, right. So, 2 marks and 1 for recommendation, 1 point for the recommendation, that what do you recommend. So, let us first brainstorm, right. Make this a habit that you do not start writing as soon as you read the question, especially the theoretical questions. First brainstorm that what points you have in mind, and I suggest that if you have more points on one side, then you just recommend that side as well, right, because in the recommendation part as well you have to justify your recommendation. So, save 1 point for recommendation as well, right. So, for instance, what would be the advantages first of all? The advantages, first one would be that if she brings Amy into the business, so she will bring capital with her, so capital investment would increase. Then of course the workload, the responsibilities would be divided. since workload will be shared, losses, if there are any losses in the company, in the business, so they will also be shared. She doesn't have to take the burden, all the burden on her own anymore. What else? If she is bringing a partner into the business, so of course she will bring her own ideas, her own skills, any specialist skills which she can offer, for instance in finance department, or ideas to increase the product range, and any other strategies which will help her in increasing her profit. Moreover, since she is operating in the similar business, so her customers will now also come in Saria's business, right? So the customers will also increase. On the other side, what could be the drawbacks of taking her as a partner? First of all, since losses are shared, so now profits will also be shared. So far Saria is not used to of this. She is her own boss. She doesn't have to share her profits with anyone, but if she brings Emmy as a partner, so profits will be shared. Moreover, she has to consult her on any important decision or any other change in the business that she might want to take. Same goes for Emmy. So both of them have to sit on the same table and discuss the changes. So this could also lead to sometimes disagreements between the two friends, right? Disagreements means the decision making process might become slower if they do not agree on one thing, right? So these are some of the points which you can write, and I have written a sample answer for you. So just so that you can just get an idea that how you can go about this answer. So let's read it. Now it says that the first and the foremost benefit of taking Emmy as a partner would be increased customers for Saria's business. This will give you 1 point. Then why is that so? As Emmy works in the same industry. Alright. Second, moreover, she will not only bring additional capital into Saria's business, but her creative or any specialist skills may help Saria in growing her business, right? So another point, that additional capital and any creative or specialist skills will help her in growing her business. However, now on the contrary, the disadvantages, I am starting the disadvantages. On the contrary, since Saria is used to of taking all decisions herself, she may not be able to accept Emmy's interference in her business, right? So this is one drawback. Now what will be the implication? What is the effect of this problem? This might lead to losing important business opportunities if they cannot agree on the same thing at the right time, right? So they might lose some business opportunities for which they have to take the decision immediately at the right time, so that they are ahead of their competitors. So therefore, what am I recommending? You can recommend the other, of course, side as well, that she goes on taking her as a partner, but I am recommending that therefore I would recommend Saria to operate as a sole trader until she doesn't need extra capital for her business, which she cannot finance on her own. So this is just my recommendation, my justification, that if she doesn't need help in raising capital to grow her business, if she is comfortable in taking all the decisions on her own, so I would recommend that she keeps operating as a sole trader. This answer is not of 5 marks, it is of course more than of 5 marks, maybe 6 or 7 marks. So you don't have to write that much, you just have to keep in mind that you are writing according to the requirement and the space given to you in the question paper, in your answer booklet. Okay. So this marks the end of this question, and this marks the end of the video as well. I'll see you in the next one with question number 2 of the same paper, right? Till then, take care. Allah Hafiz.